My name is Hugh Agro. I'm the president and CEO of Revival Gold. Revival is advancing the Beartrack-Arnett gold project in Idaho and the Merck project in Utah towards a production scenario from heap leach and exploration potential to follow.
Hugh, good to see you. I'm in your neck of the woods-ish.
Yes.
Up here at Beaver Creek. Beautiful day and beautiful surroundings. Fantastic. How's the conference going?
It's lovely to be here. Packed schedule this year. I've got our chief geologist, Dan Pace, with me, and we've got a lot to talk about.
You definitely do. Now, you're not just talking to me, you're talking to lots of investors as well. Big turnout this year, which is good to see. Gold, obviously, back in vogue again, over 2,500. Nice to see, right?
Yeah. Yeah, and the margins with the seniors and the intermediates. And just this morning, of course, we're seeing another corporate transaction, which is indicative of the broader case for businesses like ours. These projects are scarce, and in good locations, they're very valuable, and they're becoming more precious.
Yeah, well, I think it's got fairly standard behavior. When the gold prices get up here, the big boys start to move, start looking around and go, well, where is everyone, it seems. Your business model, I think, changed certainly in the last 12 months for me, is the way I'm reading it, okay? You've picked up Merck now, which I think is a very good addition, but you're very much focused on the kind of commercializing of all of the above with Beartrack-Arnett as well. So tell me what you're up to.
Well, we're developers at heart, and we've got an exploration shine to our projects with 6.2 million ounces in the western United States. We've got a lot of gold already, and hence the focus on moving those projects through development and into future production. The Merck addition for us is hugely strategic because it diversifies our portfolio. It brings us more heap leach potential around our production scenario, and it builds our scale. So our target production from these two projects is now over 150,000 ounces per year. Now, we've got a lot of work to get there to do, and we're working now at Merck on moving to a PEA by the end of the first quarter of 25. And at Beartrack-Arnett, we're advancing on permitting preparations with our heap leach project there.
So Merck has kind of like jumped the queue, as it were. It's probably, it would not necessarily your flagship because they're both quite equally good. But what does it bring to the party in terms of advancing the story?
Well, for those who are familiar with the United States, we've got federal land that is administered by the government of the United States, and you've got private land, which is administered in the most part by state authorities. And the advantage of the Merck project is that it's on private land for the most part, meaning we'll deal with the state regulatory authorities, which is it's a much more simple and straightforward process than the cumbersome federal NEPA process. And so that's the advantage for us, principally. But the other advantage is, more scale in heap leach. And we've got a lot of work to do on geological modeling to understand where the deposit goes and where the potential is for future growth there. But we're working on that now, and we're working on this preliminary economic assessment to develop first ideas on where we go with potential production from that project. But it's got scale, it's on private ground, and it's also in a really good location. Like the rest of the Revival Gold portfolio and approach, we're pursuing assets in locations that have been successfully mined before. That means we have infrastructure, capital savings, community support, and understanding. Importantly, we have understanding of the rocks and how they perform, which will allow us to move forward on a less risky basis.
Okay, which is great. I think in this market, people are more of the view of show me the money kind of attitude, right? It's been a tough 4 years, I think, right? For junior miners, for precious metals. I mean, as we mentioned, the gold price is back up there. It helps money circulate around the gold companies. But if I looked at your project pre-Merck, it was, sort of 63,500 ounces. That's, 8-year life of mine. It was sort of sub 1 gram per ton. It kind of looked okay. It looked okay. But it wasn't moving quickly enough for some people, I would argue as well. So Merck, the addition is, how are you viewing this kind of commercialization of the whole? That's what I'm interested in.
Yeah, you're a tough audience, and that's why I like you, Matt. But the thing about a project like the one we have at Beartrack-Arnett is that we're working from existing infrastructure. And so a lot of people can talk about these massive projects that have all this great scale and potential around them, but actually delivering on those projects is complex. And we've got lots of examples of, $500 million, $1 billion projects that become, billion or $2 or $3 billion projects. Lots of examples of that. Lots of examples of timelines for permitting that get stretched out over decades. And the advantage of Beartrack-Arnett and what we've got started with there is that we've got a developed site. We've got all that infrastructure we can redeploy, and we've got a relatively modest capital at just over $100 million. So that gives it a lot of advantage. And yes, it's 63,000 ounces a year of production, but that's where the exploration comes into it, and the potential to bolt on the underground potential as we continue along the strike of the mineral deposit and develop out that potential.
But that gets back to
now,
the
sorry,
future.
I just want to think, because you asked me about the Merck fit with that, and you're right. We do want to move more quickly into free cash flow and with more scale. And so with the addition of Merck, we're doing that. And we're doing that with projects that have operational synergy around them, because our team is based in the Western United States. The projects are very similar in their approach. And our team has familiarity with both these jurisdictions and with these assets. So our permitting preparations move along at Beartrack-Arnett. We're advancing engineering at Merck. And again, the major targets there that your viewers will want to look to are that PEA and the first quarter at Merck. And while we're doing that, we're continuing to progress the permitting preparations at Beartrack-Arnett and build the exploration business case for future drilling.
Okay, so I think the package looks good now. Okay, looks great. It's good. Good is such a boring word. But I say with Beartrack-Arnett, okay, talking about exploration, that's again to people said, oh my goodness, that's some ways away. The margin, because you mentioned a really important point there. You've got all this infrastructure sitting there, right? And the 100 million market cap, capex. Yeah. That's something. That's something. And the other thing that brings into the equation is time frame. So actually, in terms of when you've got the permits and licenses to do all of the above, the time frame to get into production or ramp up to capacity is shortened. So I think that's quite good. But I'm now kind of interested from what you said in terms of the money generated, the early money generated from Merck, and what that can do for Beartrack-Arnett.
Yeah. So let us get through that PEA phase, and we'll be able to give you a better idea on where we see capital coming out and where we see potential costs coming out. But just broadly speaking, when we acquired Merck for $22 million, we bought 1.6 million ounces of resource. And we see the potential for this to be part of a heap leach plan that produces something in the order of 80 to 100,000 ounces a year of gold.
What sort of grades are you talking about?
Grade on the current resource is about 0.6 grams per ton gold.
Right.
In an open pit setting.
Right.
And so,
which means cheaper.
Which means cheaper. But remember, we're in a location that has been mined before. So we have a really good idea of where costs are. We have available people. And all of those things de-risk the project. So that 0.6 grams is not up in the Arctic. It's not in a tropical jungle.
We're 1,000 meters
about a 45-minute drive from Salt Lake City, Utah. So this is important to the overall economics and the point you're getting to. Now, I'll come back to Beartrack-Arnett. That project, 24% return on an $1,800 gold price after tax. And that's the kind of economics that I think we'll see out of the Merck project as well.
1,800. Do you have that's the kind of base case. What's it look like at today's prices? Any sense of that?
I don't even think about it at this point, Matt, because look at 6 months ago the gold price was expected to be back down at $1,800. Today we're at $2,500, and there are folks who thinks it's going to $3,000. So Look, we're dealing with a conservative gold price assumption. We know that there's always going to be cost pressure in the mining space as these metal prices go up. We're going to see cost pressure. So we work on a conservative gold price assumption, somewhere $1,800, $1,900.
I'll work out the numbers separately, but the point is, if we can get that moving quicker than Beartrack-Arnett, I think all of a sudden I'm pretty interested. If it's, say open pit, that's kind of interesting. It's already been mined. So there's a lot of the economics are kind of sort of taken care of, or known at least. What I'm interested in is the time frame, though, because you talk about the PEA. Obviously, we need to wait for the PEA. Given its previous status as producer, etc., can you jump a few stages? Do we need to go through the usual economic study?
Yeah, that's a good question. We'll know more about that in a few months' time.
Right.
I'll be able to speak more definitively about
Q4.
Timelines. End of first quarter next year, we'll have that PEA
Okay, got it. Okay.
But broadly speaking, we think it'll be something in the order of 3 years to complete permitting for Merck. And so are there opportunities to potentially improve on that? Possibly.
Right.
We're just now engaging with the state authorities to understand the pieces that are involved with that, and we'll have more to say about that on the completion of the PEA.
Right.
But again, I point to the fact that private ground, federal process avoided.
But a lot of boxes ticked. Great. With regards to these markets and how companies had to adjust, reassess their thinking, it's inevitable, I think, because repeating the same thing over and over and expecting different results has been, I think, terminal for some.
True.
Right? So I think you're doing a lot of that, changing the parameters to make sure it works in your favor. One of the things that companies are having to be concerned about is the allocation of capital. When you talk about exploration in a market like this, where there's no credit given to you despite positive results. So do you think drilling is going to be the right thing to do in terms of exploration across the portfolio in a market like this? Or is it focus on, let's get that revenue going?
Yeah, listen, job one is to get that revenue going.
Okay.
That's job one. But, the way I think we need to look at this business is that it's a series, it's a portfolio. And we are always going to take some more risky bets on, those opportunities that turn into massive returns for shareholders. So we've got to have a balance. We've got to have a balance of progressing our projects, moving towards free cash flow, while at the same time exposing the market to the value in our portfolio. And here's the reason why. We don't want to be that company that gets taken over without our investors, the market, knowing the possibilities in our portfolio. And we've got 30,000 acres land position. We've got one of the biggest mineral systems that's been discovered in the U.S. in the last 10 years at Beartrack-Arnett, with 15 kilometers of potential strike for future exploration. Now, that may not be front and center for investors today, but I think they want to know what the possibilities are around that.
For sure. And I guess it must be frustrating when the market is not kind of giving you the value you think you're worth, or for the work that you've done, to suddenly have someone come in and then take all of the upside, right? I get it. But at the same time, strategic partnerships, investments are, like de rigueur at the moment. It seems people need money from wherever it comes from. Where are you looking with these conversations that you're having? Are we strategics, or are we in the market? How do you view it?
Yeah, we are very active on the corporate development front with a number of different potential corporate strategic investors, as well as some of the more sophisticated institutional funds that are doing some pretty creative structures. And part of the story is moving to free cash flow, and part of the story is that potential in our mineral systems. We got an orogenic gold system in Idaho. We've got a Carlin type deposit in Utah, and both of these are gems. And in a world where gold deposits of scale are becoming more and more scarce, These are precious assets.
That's the thing that you're concentrating on, making sure that a strategic partner or industry partner sees what you've got. Because it's like a lot of companies focus on, what do I need? What headlines do I need to get the market enthusiastic? Others go, well, actually, I know what the big guys want, so I've got to build that, surely.
Yeah, well, it's part of our pedigree. If you look at our board and our team, we're all people who've worked in larger organizations and understand the dilemma that corporate development teams, CEOs, boards of directors face when you're producing 2, 3, 4 million ounces a year of gold, and you've got to replace that every year. It's the reason why AngloGold has just bid for Centerra. It's the reason why Gold Fields just bought Osisko. It's the reason why Newcrest was purchased by Newmont, and this rate of discovery running at about 10 to 20 million ounces a year is not enough.
Yeah, it's not enough, but at the same time, I'm just sort of intrigued by, you've got to protect your shareholders now. This doesn't need to be a good deal for whoever the acquirer. There's got to be a good deal for both both groups. You're probably not at that level in terms of measured and indicated ounces, which is going to drag in a potential bidder, are you? Or do you feel, what more work have you got to do on that front?
Well, look, I think in today's environment, it's not enough just to, put 9 holes into a deposit and hope that you can sell it for $1 billion. Of course, I'm talking about the great success of Eric Heap. But today, I think investors, corporates, participants in the industry are more sophisticated about their approach. So we've got to knock off those other things: permitting, metallurgy, construction capital, team, community support, indigenous relationships, all of those pieces. So it's a multifaceted program, and we're working on all aspects, not just exploration, because the sophisticated parties that we're approaching for funding for future progress on the projects are looking at all those things.
They'll also be looking at the structure of the deals. You've just recently done a bit of restructuring there, and sort of got rid of some immediate, I guess, financial burden, and put into kind of the future category was it 0.3 NSR?
Correct. Yeah.
Right, okay. What are the terms around that one? Because if someone comes in, they want to be able to kind of take that NSR out presumably, if they can.
Yeah, whether we finance the construction at Beartrack-Arnett ourselves or somebody else gives a better case for our shareholders to do it. The objective of that restructuring was to convert what today is a $27 million or was a $27 million cash payment into a 0.3% NSR. So we've taken the burden of that cash payment away from the project, and I think it's a win-win arrangement for our partner at Pan American and ourselves. It incentivizes Revival Gold to continue to progress the story and build out the exploration potential without the burden of a cash payment and in a tough capital market, right? So I think this is a win-win, and look, it improves the value proposition for investors today. Today we are trading at plus or minus $7 an ounce in the ground. U.S. projects advancing towards free cash flow on a good brownfields, low risk locations, and with a team that's done it before.
Good man. Good to see you, and good luck. I know you're busy. Be nice to maybe hear back from you afterwards. Give me a call. Let me know how you got on. Okay.